So we'll be looking at the Australian economy and establishing a confidence index for that country. We will look through several indicators like inflation, GDP growth, unemployment, trade, wage growth, and other factors. And based on that, we'll make the final decision. Is it reliant to invest in that country or is it not? Based on GDP deflator starting from 2000 till 2023, the inflation rose in Australia by 113%. There are several factors that contributed to this growth, especially the revenue gained from exports. Let's break down what caused this inflation growth. Starting from 2000 till 2012, Australia experienced a massive export boom in iron ore and coal. Australia was a major exporter of these resources to China. Coal and iron ore exports were mainly driven by China's demand of rapid industrialization and its high demand for steel-making material. Given this rising potential and increased demand for resources, Australia's dollar appreciated, driving in capital flows, increasing GDP growth, employment, and increased wage growth in mining regions. In Western Australia, high wages in the mining sector led to increased housing demand and costs, creating inflationary pressure in mining regions. And since housing prices are part of the CPI rose. In 2010, Australia capitalized on a new wave of resource demand, this time in liquefied natural gas, driven largely by Japan, South Korea, and China, leading more to currency appreciation, wage growth in those regions, and inflationary pressure in housing prices in those regions, which later spread across the country. From 2000 to 2012, Australia's inflation rate grew by 56%. GDP grew by approximately 275%. That's a 219% real growth. From 2012 to 2016, Australia's inflation rate was practically 0%, mainly due to less demand for commodities from China, which in turn didn't put any additional inflationary pressure on housing. Despite this, the global economic outlook was of low inflation, meaning that even though the Australian dollar fell and didn't cause inflationary pressure in imports, inflation stayed low. Since the demand for commodities fell, the Australian dollar also experienced a significant decline. But due to the decline, other sectors could favor this situation. Manufacturing and agriculture, for example, were able to become more competitive globally. From 2017 and onward, Australia shifted parts of its economy from commodity exporting country to service-oriented one. As of now, mining contributes approximately 11% to GDP, service contributes 17%, and manufacturing 6%. Since 2019 till 2023, Australia's inflation rose by 22%. So in 4 years, the inflation rose by 22%, and the rest 91% rose during 19 years. During the last 4 years, Australia's GDP grew by approximately 23%. That's 1% real growth in 4 years. All this growth was artificial despite the government using quantitative easing to stimulate the economy, which is fake growth since it will have consequences later on. From the year of 2000, Australia's manufacturing contributed approximately 13% to GDP and employed approximately 1 million people, which at the time was approximately 5% of the population. The decline was contributed mostly by mining booms, since the demand for commodities was greater than the demand for manufactured goods. The currency rose in commodity exports, making manufacturing less competitive globally compared to countries in Asia. By the year 2016, several automotive companies like Ford, Holden, and Toyota ceased their manufacturing operations due to high production costs, small domestic market, and limited export competitiveness. This was a heavy hit despite having lower demand for commodities, which by itself contributed to job loss. Now manufacturers contributed to additional job losses. Australia decided to shift their focus more on advanced manufacturing and implement more advanced technologies, like robotics, automation, and digital manufacturing technologies. This helped Australia make manufacturing more modern and competitive, and rebalance resources to new sectors. Despite these advancements, they were mostly thanks to government incentive programs like the 2020 Modern Manufacturing Strategy, aimed to boost resilience in critical sectors such as medical products, food and beverage, defense, and resource technology. So, as you know, most developed or advanced economies switch to service-oriented economies through time. Same is true for Australia. Australia's service sector employs approximately 80% of population, reflecting sector's capability to absorb labor from declining sectors like manufacturing and agriculture. Most contributions to Australia's service sector come from healthcare, finance, education, tourism, and IT. Considering its healthcare sector, the demand is most driven by the aging population from hospitals to aged care facilities. Technological advancements in healthcare have further expanded services, with telemedicine and personalized care gaining popularity. Australia's financial sector deserves a separate applause. During the global financial crisis, Australia's financial system emerged relatively resilient compared to the banking crisis in the United States and Europe. Australia was one of the few developed countries that avoided a recession during the global financial crisis. Australian banks did not engage heavily in subprime mortgage lending, which was at the heart of the crisis in the US, nor were they deeply exposed to the complex derivatives triggered financial collapse globally. The financial sector contributes approximately 11% to GDP. As for education, international education became one of Australia's largest service exports, attracting students primarily from Asia. By 2020, education was amongst Australia's top export earners, with the sector contributing billions annually. The educational relationship between Australia and China spans over 4 decades, emphasizing policy dialogue, information sharing, and partnership aimed at achieving mutually beneficial outcomes. As of 2011, China was the most popular destination for Australian students studying overseas. As conversely, Chinese students have been a significant demographic in Australian tertiary institutions. India has become a major source of international students in Australia. In 2022, there were 96,000 Indian students in Australia, and by the second half of the year, India overtook China as the top country lodging students' visa applications. This surge reflects India's growing interest in Australian education and the strengthening of bilateral educational ties. Australia and Indonesia share a long-standing educational relationship. In 2011, over 17,000 Indonesian students were enrolled in Australian educational institutions, studying fields such as management, commerce, social sciences, and hospitality. Initiatives like the Australian Award have facilitated educational and professional development scholarships for Indonesians, contributing to the development of Indonesian human resources. Australia's engagement with Southeast Asian nations extends beyond individual countries. In 2017, over 100,000 students from Southeast Asia were studying in Australia, accounting for a significant portion of the international student population. This underscores the region's recognition of Australia's high-quality education system and the mutual benefits derived from such exchanges. Despite Australia being a major exporter of commodities and LNG, it was in a trade deficit up until 2016. Australia, the largest exporter of commodities, in a trade deficit. The trade surpluses started when China became one of the major trading partners of Australia. Other trading partners including US, Southern Korea, India, and Southern Asian nations. With time, Australia became a larger exporter, not just because of commodity prices, but also because of agriculture, education, tourism, healthcare services, medical technology, and financial services. Agriculture, particularly beef, wheat, wool, and wine, has been a long-standing component of Australia's exports. Increased demand from Asia, particularly China, Japan, and South Korea, supported growth in this sector. The Free Trade Agreement with Japan, South Korea, and China in 2015 helped boost agricultural exports by reducing tariffs and enhancing market access. Education emerged as one of Australia's largest service exports, driven by an influx of international students, primarily from Asia. By the late 2010s, education became the country's third largest export. Tourism was another key export, with Australia attracting millions of visitors annually. China became the largest source of tourists by 2010, but the COVID-19 pandemic temporarily disrupted this trend as travel restrictions halted international tourism. Over time, Australia has diversified exports to include high-value goods and services. These include healthcare services, medical technology, and financial services. Australia's advanced manufacturing sector contributed specialized products such as aerospace components and medical devices, aiming to complement traditional commodity exports. Manufactured goods, particularly electronics, machinery, and vehicles, have continuously dominated Australia's imports. With global supply chains increasingly interconnected, Australia sourced consumer goods, electronics, and industrial equipment primarily from China, the United States, and Europe. Over time, China became the primary source of imported consumer goods due to its manufactured scale, cost advantages, and diversified export portfolio. Despite being a major energy exporter, Australia imports refined petroleum products, including gasoline, diesel, and jet fuel, due to a reduction in domestic refining capacity. The digital transformation in Australia led to a substantial rise in imports of technology products and services, including telecommunications equipment, computers, and industrial machinery. Capital goods imports grew due to infrastructure investment, particularly in the mining sector during the 2000s and public infrastructure projects in the 2010s and 2020s. Australia's import profile also reflects a large demand for vehicles, with passenger vehicles and trucks ranking among the top imports. The automotive sector transformed from a local manufacturing base to a fully import-dependent market after Australia's last domestic car manufacturer ceased operations by 2017. But how did Australia compensate the trade deficits that it had up until 2016? The solution to trade deficits or current account deficits are capital inflows. There are different types of foreign capital inflows that can offset deficits. One of them is foreign direct investment, which is a subject of another video. Australia's interest rates were mostly low to support economic expansion, but have risen post the pandemic and currently are at 4.35%. In 2019, government debt to GDP was 19.2%. Now, till 2024, it has risen up to 43.8%, which is moderate but should be paid off ASAP, since if a situation like this occurs again, and if they will take the same measures by injecting QE programs into the economy, the interest rate on that debt will rise. But given the M0 monetary base and the central bank's balance sheet, you can clearly see that the balance sheet has shrunk from a high of 645 billion to 433 billion, still 200% higher than pre-pandemic. Australia's currency is floating, meaning its price is determined by market forces, like supply and demand. Australia is also considered a commodity currency, since its price is dependent on global commodity prices like iron ore, coal, and LNG. Since Australia's economy is strong and the currency is stable, many central banks use it as a reserve currency. The Australian dollar is often seen as a risk-on currency, meaning it tends to appreciate when global economic conditions are favorable and investors are willing to take risks. During periods of global uncertainty, investors tend to favor safe haven currencies like the US dollar, Japanese yen, leading to Australian dollar depreciation. For example, the Australian dollar saw declines during 2008 crisis and the early stages of the COVID-19 pandemic in 2020. Australia's unemployment rate ranged between 4 and 6% over the past 2 decades, peaking at around 5.8% during the global financial crisis and 7.5% during the height of the COVID-19 pandemic. By 2023, unemployment was at a multi-decade low of around 3.5%. While unemployment has been relatively low, underemployment has been a persistent issue. This trend reflects the increase in part-time and casual work, with many workers wanting more hours than they can find. Unemployment has remained above 8% in recent years, indicating an ongoing challenge in matching workers with full-time positions. During the early 2000s, wage growth was relatively strong, with annual wage increasing often about 3 to 4%. This was driven by a strong economy, low unemployment, and high demand for labor in sectors like mining, construction, and finance. Following the global financial crisis, wage growth began to slow down as the economy shifted towards service-based industries and demand for high-wage jobs in mining and manufacturing declined. Wage growth stagnated. An annual increase fell to around 2% or lower from 2015 onward. During the COVID-19 pandemic, wage growth was initially suppressed due to economic uncertainty, job losses, and the adoption of wage subsidies through government programs like JobKeeper. However, as the economy recovered, tight labor markets led to slight wage increases in certain sectors. So given these indicators that we just looked at, I would say it's not very confident to invest in Australia, but overall the global economic conditions are approximately the same as Australia, many countries facing declines or slow GDP growth. With that being said, I advise you to make your own research before doing any investment decisions because you can lose your money. But since the global conditions are so bad, maybe it's a good time to buy the dip, so to say, since sooner or later the conditions will recover. It may take time, of course, unless something unexpected happens, which it can and has happened in the past. But overall,